This set of slides provides a global tax overview. Some major sources of government tax revenue include income taxes, wealth taxes, and taxes on consumption. Income taxes refer to salaries, interest, dividends, realized capital gains, unrealized capital gains. Wealth taxes are taxes on wealth transfers and on value of holdings, especially real estate. And taxes on consumption are the same, like our GST, value-added taxes, and sales taxes. The common elements of taxes around the world are having a tax rate structure that applies to ordinary income, such as earnings from employment. Other taxes may apply to special categories of income, such as investment income, like rents received from renting out your investment house, capital income. Investment income is often taxed differently based on the nature of the income, whether it's interest, dividends, or capital gains and losses. In a progressive structure like Australia and most nations, the tax rate increases as income increases. There are a few countries with a flat income tax rate. Kazakhstan, Russia, and Saudi Arabia are a few. In tax planning, it's useful to think about how much tax would be paid on additional income, known as the marginal tax rate, and how much you can earn in the current highest bracket before going into the next highest bracket. Many countries provide special tax provisions for interest income. For example, in some countries they provide an exemption from being taxed on interest income, like in Argentina, a lower rate of tax in Italy, or they may exempt from an inflation adjusted from being taxed on fixed income instruments. Dividend income may also have special provisions. In some cases there are exemptions, special tax rates, or exclusions. In Australia, we have provisions for mitigating double taxation because dividends are a distribution of the company earnings, and the company may have already paid tax on those earnings. So tax credits can then be used to mitigate the effects of double taxation, where credit for a portion of the taxes paid by the company are credited to the individual, and we call that franking. Capital losses or gains may have special provisions or rates. These often vary depending on how long the underlying investment is held. Generally, long-term gains are treated more favorably than short-term gains, but may be defined differently in different jurisdictions. Total or partial exemptions may apply, or favorable tax rates may apply. There may be more favorable treatment for domestic companies. In most cases, only realized gains were taxed when the investment was sold.